I was hoping Jonathan would be late, but here he is.
Hello.
And right on time. Good. So we're back with municipal bonds. Go ahead.
Great. I'm sharing my screen with you now. Can you guys give me a thumbs up if you can see and hear me and see my screen? Excellent. Great.
Golden.
It's an honor to be a part of this conference. I'm very happy to be able to talk about this paper and the research. I'm particularly grateful to the organizers and very grateful to the discussant with whom I've had a productive back and forth after sort of an earlier draft of this paper. I'm talking about the municipal bond market. Municipal bonds are the key tool for financing public infrastructure in the United States. A lot of times it's sort of rather sloppily called in the US the tax exempt market. Most of it is tax exempt. If you have to know one thing about the muni market in America in the post-war period, it would be that default rates on the rated part of the muni debt universe have been low enough, default has been infrequent enough, certainly at large issuers, that really each case of default is its own animal. And what that means is that relative to, for example, the corporate bond market, I think we have a little bit less confidence in our predictions about what might happen in the event of municipal defaults going forward. There's just a lot more uncertainty about that than there might otherwise be. And that reflects to some degree the historical high credit quality of that asset class. And so with that out of the way, what I want to do in this talk, I'm going to start actually by mentioning some things that I didn't do in the current draft, and I didn't do them on purpose. It's like, on purpose, like there's a narrow scope of my aspirations. And so this isn't in the draft. It could have been, but it's not. Then there's some things that are kind of not in the current draft, and it's because my intent, I think it's necessary when talking about municipal bonds to actually cause a little bit of offense. Like I hope to offend, some subset of the people in the world with this draft, and I want to be cautious and careful about how I do it. I hate to cause offense by accident. I want all offense to be purposeful. And then I'll talk about parts of what is in the current draft. So what I'm not doing here, I'm just talking about the United States, right? There's a huge, other countries have their own equivalents to the US municipal bond market. China has a particularly large one, but there are big ones in Europe. I think that's beyond my aspirations. I think that they're interesting, but I think that it's impossible to really do that well in one chapter, given the different institutional structure of those areas. What's not in the current draft, but we'll get there, and I'm refining my thinking about this, and the conversations with Francisco have been helpful in that process. As you know, the Fed has recently deepened its involvement in the municipal market in the United States. So during the COVID-19, the liquidity crisis part of the pandemic, the Fed initiated the municipal liquidity facility. I think there's now some evidence that the Fed's intervention at that point short-circuited a growing liquidity crisis. And so, had I been in the room, I was, I'm a professor. I was not in the room for those decisions, but I think they're certainly justifiable. But I do think, the municipal bond market is kind of the beating heart of American politics, for better or for worse. And I think that, also, I think mostly for worse, the Fed is unique among American government institutions right now in its functionality, like in its ability to do stuff. And as we keep on having gridlock, the Fed keeps on moving into vacuums that if it didn't move into, you would have had, I think, even worse crises than we have. But I think the muni market is dangerous because, I mean, this is really where you've got politicians, like this all stuff is all issued by politicians. It's unavoidably political. And so I see some risks, even if I think that the decision in 2020 was perfectly understandable. You know, the muni market is a weird zoo, right? So imagine like the world's weirdest zoo of different types of instruments, right? And I think in the current draft, I went into kind of weird zookeeper mode of describing all of, you know, going through taxonomies here. The meta point of that, what is the larger point of this? There's a lot of weirdness in this market, in part because there is some amount of legal engineering that has been used to get around restrictions on debt issuance, right? So if you have a statutory restriction on the amount of debt or the process that you have to follow to issue debt that will have, you know, a general obligation claim, a claim on tax revenue, you see issuers doing pretty arcane things like, you know, you set up a special purpose vehicle, the vehicle issues certificates of participation, that entity then buys a building for a public purpose that is leased to the underlying state or city, and then you have a situation where you have engineered a structure that gets around having the legal reality of being called debt while having the economic substance of debt. And this is a barrier to entry, both for the type of fast moving capital that you need to come in order to short circuit a crisis. Like if you think of, you know, supplies of capital are harder to bring into really opaque market. And it's also a barrier to entry for research, and it's not benign. Like this is, I mean, it's understandable, but I think that a lot of the arcane stuff that we see in this market is socially wasteful. Another type of socially wasteful financial engineering, this is not legal engineering, but financial engineering. You see a lot of floating rate or variable rate issuance, right? And this was at the core of the liquidity crisis in March of 2020, right? But it's important to see what the underlying purpose of this variable rate garbage is. You have an issuer that wants to do the substance of issuing a fixed rate bond. But what they do is they issue a variable rate instrument with coupons that are going to float based on some sort of quasi-auction mechanism. And then you do a swap tied to LIBOR, right? So you end up with, on net, you end up with something that is synthetic fixed. Now, why do this? You know, the answers are not always pretty. So the dealer underwriting fees that you can embed in a swap contract are relatively opaque, right? If you put your underwriting fee on a fixed rate bond, you actually have to reveal it. But if you do floating and then a swap, it's easier to hide your fees, right? It also allows issuers to monetize LIBOR muni risk, like the sort of the basis risk on that is something that, you know, like you get paid for taking that risk. It's a risk. And so when the market was melting down in 2020 and the Fed had to step in, you know, the part where the meltdown was really affecting issuers, where issuers were having trouble, was where they had issued this type of synthetic fixed structure, which itself is I think, this is on some level socially wasteful financial engineering. Another type of socially wasteful financial engineering, you've got, if you go through the taxonomy of the issuers, you'll see some weird issuers. A lot of the top issuers are pretty familiar. You've got California, you've got New York, you've got like 50,000 issuers. But then you see some issuers that are even most muni people don't know about. So you've got these highly structured programs that allow you to get around the IRS regulations that are intended to prevent borrowing to support, borrowing against tax-exempt debt, right? So you basically, put a muni in a trust, you issue a floater and a residual receipt, and this is what was melting down. And so when the Fed steps in, it was disproportionately that intervention was aiding a part of the market where, in the top case, the entire purpose of those floating rate instrument programs is to do something that is really just sort of a fig leaf getting around what the IRS in fact doesn't want you to do. And so it's worth at least naming the reason why these things were melting down. This is not an issuer is not going to be vulnerable to that type of liquidity problem if they've issued 30, level payment 30-year fixed coupon debt. Right? Then the paper goes into a sort of a taxonomy of investors. The thing that distinguishes the muni market is the role played by households, high net worth households. It really is sort of a very disaggregated market in that sense. And in that sense is somewhat, if you have that combination of opaqueness, you have some underlying risk, the vulnerability to crisis is going to be a function of how much capital is available to respond to dislocation. And all of this opaqueness and all of this, to some degree, socially wasteful engineering reduces the robustness of what otherwise would be a pretty robust asset class. So then I go in the paper, I go through the existing research on the muni market. I think my favorite paper is actually one that is I think undercited. David Cutler, Cutler and Miller, they have this really cool paper, noting that we die much less frequently of dysentery than we used to, and they tie that to the growth of the muni market. I'm really optimistic about new empirical research that is really getting into the spatiality of infrastructure investment. And I'm also enthusiastic about research. So Brooks and Liskow have a great paper where they're focusing on the growing price of infrastructure investment. If you look at the cost of building highways, for better or worse, I said I wouldn't talk about China, but for better or for worse, it looks like the Chinese are just able to build highways much cheaper than what we see in the United States. Another part of the literature that I think is important has to do with pensions. In general, municipalities have balanced budget requirements. The way around those has been to borrow from your employees in the form of pensions, and the accounting for this is just ridiculous. And so there are a lot of papers. I think the heroes of this literature, Brown and Wilcox, Rao and Newby Marks, have been pointing out that these pension liabilities are undervalued, and there's some research showing that the accounting treatment of these liabilities creates incentives to tilt towards risk. There are some good new papers looking at defaults that are the defaults that come before you file for bankruptcy protection. So a great paper by Agrawal looking at when you get into distress, it looks like some municipalities that were, not all the way in default, but they were near distress, stopped investing in their water systems in a way that was hazardous in terms of lead exposure. And so I think thinking more broadly about not just bond market default, but service default is something that I'm optimistic about. I'm really optimistic. There's a bunch of new work. I think a lot of researchers are now casting looking at this market and getting familiar with the institutional detail that has been somewhat of a barrier going forward. But there's a lot of good work on the optimality of issuer behavior with respect to a number of different questions. So advance refunding, the use of bond insurance. Another area of research has been on trading costs, both in the primary and the secondary market. And the big message of that literature is that the real-time reporting of trades has brought down certainly the variability of trade costs that investors are facing, both in the primary and the secondary market. I should say, there's nothing like muni markets. Municipal bonds are incredibly expensive to trade, right? I mean, first off, there are millions of them. There are 50,000 different issuers. It's just a sort of an expensive asset class, illiquid asset class. But there's a great paper by Green and BA that show that before World War II, you had municipal bonds trading at very low transactions costs on the NYSE. And so there's there's nothing intrinsic about the asset class that makes transactions difficult. And I'll sort of close with a word of warning to all consumers of this literature. You have to be a little careful because you've got a market that has 50,000 issuers. You've got 1 million different instruments. And if you're not careful, you could plausibly prove anything, depending on sort of what subset you look at or how you weight things. And so I think that although I'm optimistic about the research in this literature, I think it's important for people to just be aware of how much dispersion there is. It is a very unusual zoo. And so I think I'm exactly out of time. It's 1:45. I'm grateful to the organizers for including this, and I'm super grateful to the discussant for a productive back and forth. I'm going to pause now and I'll unshare my screen.
And let's see whether you should actually be grateful to the discussant or not.
I'm contingently grateful. I'm possibly grateful.
Go ahead, Francisco. All right, we see, but we don't hear yet. We don't quite hear you, or at least I don't quite hear you.
I hear a little bit.
Yes.
It's very muted.
You sound like a 1980s landline.
Can you hear me now?
Ah, yes.
Okay, so headphones made the trick. All right. Okay, so thanks a lot for the invitation. Also, thanks, Dan, for the exchange we had been having. I think that was super useful for me to get some more background on the chapter. So before I begin, the usual disclaimer applies. So let me just give you a brief overview of what I intend to do in this discussion. First of all, I'm completely new to this literature, so I might talk like an outsider. So after reading this paper, I thought it was a really nice paper. I did learn a lot, so I think that the chapter accomplishes what it's meant to do, to give someone that is outside the literature like a good understanding of this municipal bond market, and also what are the main questions that people have been asking, and also where to look for further references. So here in this discussion, what I want to do is first give an overall sense of how the paper looks like, and my comments on the structure and balance. Then to provide basically suggestions about topics that are already in the paper and that I think it might be worth expanding a little bit. And then other topics that I thought could be interesting but are not in the paper, and I'm gonna talk about what I found in the literature about those topics. Okay, so the paper has 6 sections, but those 6 sections can broadly be divided into 2 parts. The first 5 sections is actually a documentation and explanation on how the municipal bond market works. So it's an overview where it gives you basic features of the municipal bonds, the bond life cycle, the issuer, the investment base, and the regulatory framework. And I found that just by counting pages, this is a 16 pages portion of the paper. And then the second portion of the paper is mostly on what the academic research has focused on this bond market, and Dan touches upon several interest topics about the beneficiaries and distribution implications of tax exemptions, the role of credit ratings, the muni puzzle, the optimal security design, the effect of pension liability, default risk, and the trading and primary and second markets that he has just discussed. So one basic comment that I have is I think the balance right now is tilted a little bit more to the overview part, and I think the meat is really on the second part. So I was glad that is not the case in the presentation. Actually, in his presentation, he devoted more on the research topics than describing just the municipal bond market. So I would actually encourage him to follow that balance in the paper as well. Having said that, I think it's important the first part, because as Dan stressed, this municipal bond market is very large. It's actually one of the largest and most important capital markets in the US. It has like about 4 million trillion in market capitalization, 55,000 users, issues, and it's a very distinct market from what we are used to study. I think the first part has to convey mainly the main frictions that are there in the and characteristic of the bond market, which I found is this fact that most bonds are tax exempt. Actually, in the papers I read, they actually talk about synonyms about municipal bonds and tax exempt bonds, although there has been a surge in taxable bonds. And as Dan stressed, I think the municipal bond trading is still very obscure, which is organized in a decentralized broker-dealer market, and there is limited pre-trade and post-trade transparency. So that's one of the key characteristics I found exciting about this market, and that also results in strong liquidity problems in this market. Okay, so just let me go to some comments first. While reading this literature, I found that one of the main problems discussed is what is known as the muni bond puzzle, which is basically states that like municipal bond yield curves are generally steeper than treasury bond curves, and so the tax exempt yield curve tends to diverge from the after-tax treasury yield at longer maturities, and this is what is called the muni bond puzzle, which is basically that computing an implicit tax rate from the yield difference between taxable bonds and municipal bonds gives reasonable tax rates at short maturities, but unreasonable low tax rates at long maturities. So Dan, in the paper, he touches about these papers that document this the muni bond puzzle, and offers some papers that offer some explanations. But I feel that more explanations can be given, and I found that there are actually some important papers, or at least heavily cited papers, that try to explain this muni bond puzzle, which were not discussed in the paper. So among those, I think there are two that I found have received a lot of attention in the literature, especially the first one by Longterm in the Journal of Finance in 2011, where he argues that tax risks may explain part of the muni bond puzzle. So in that paper, he estimates an affine model for the term structure of municipal swap rates and finds a negative tax risk premium. And then he rationalized this finding, meaning that investors require lower yields for holding securities that are most sensitive to tax rate changes. So if one assumes that the sensitivity increases with maturity, everything else equal, tax exempt and taxable yields will converge for longer maturities. So I found that would be a nice addition to that section of your paper. And then the second reference is this paper by Wang, Wu, and Zhang of 2008, where they suggest that liquidity premiums may play an important role in explaining the muni bond puzzle. So basically, they extend actually the Green's paper, which you cite in your chapter, to account for default risk and add the sensitivity of tax exempt yields to market liquidity shocks. And they find that tax exempt longer maturities are more sensitive to market liquidity shocks, and therefore they require higher liquidity premiums, and thus they offer some explanation on the bond puzzle. So I think adding these two, because you have a citation of Schubert 2017 where they actually find that credit risk is most of the explanation. I think complementing with these two would be actually nice. The second thing that Dan touches in his presentation and the chapter is on default risk. So municipal bond defaults have been rare episodes. However, this paper by Schubert in 2017 that actually Dan mentions in his chapter and discuss it, they estimate that default risk accounts for 74 and 84% of the average spreads. However, this to me sounds surprising, because I think the evidence shows that that municipal bonds have been rare episodes. So what is accounting for all this default risk that is estimated in this paper. So here, I think that there might be some alternative explanations that are, some of them are already in the literature, some maybe open questions. So two things that I thought about. The first one is maybe there is an interesting interaction between default risk and liquidity. As Dan mentioned, the municipal market suffers of very severe liquidity problems. So here there is a paper by Melbrad in 2014 for corporate bonds, where they model the interaction between default and liquidity problems, and they show that this interaction is important for accounting for the spreads and liquidity measures in the data. So maybe there is some explanation along those lines that could be applied for the municipal bond market. Moreover, there's a recent paper by Gordon and Guerrón Quintana, which is closer to my research agenda, where they use a similar type of model of sovereign debt default, but for the municipal bond market, and they study the interaction between borrowing, immigration, and default risk. And they actually show that immigration can actually explain a lot of the default risk in the municipal bond market, because the immigration, by increasing the people in the municipality that pay taxes, and they have effects on the borrowing decisions
of I'm a bit worried that you seem to be in the middle of your slide deck and you're a minute past your time already.
All right. Yeah. Okay. So that, yeah. How long do I have? One
you should have done a minute ago.
Okay. All right. So then, just to give you a brief overview, there are some political economy and aspects considerations that I think could be further included in the chapter, which is of political polarization, contestability, financial innovation, and I have the references there, so that there's an active literature explaining some political economic considerations in this municipal bond market, which I thought could be expanded in your chapter. I had something similar along the lines that Dan stressed about the COVID-19 and the role of the Federal Reserve, so I think we are in the same page on that thing, so I think the chapter might actually be good if you could study the role of the Fed in the pandemic. Finally, I think there is a climate change related topics. There is a lot of development in the municipal bond market and the issuance of green bonds. Actually, you have a paper there, so I'm actually encourage you to cite your own work on the effect of green bonds and municipal bonds. So, and there are some other considerations that I don't have time to go over, but overall, I think this is a great chapter, and I really enjoyed reading your paper. And sorry for going over time.
Thank you very much for a very comprehensive discussion, although you didn't get to deliver all of it. But the floor is open for general comments. In chat, Stefania has a note and references on the fact that not only did the Fed intervene in the muni market, it successfully intervened in the muni market. Are there other contributions here? Or should we go back to Dan so that he can respond for a minute or so?
I'm happy to respond if I'm able. All these comments are very good comments. I'm just grateful for all of them. I think that my only plea is for more space. If I can have more space, because obviously these comments are very good, and I appreciate also the point from Stefania in the chat. So that's it. I'm discussing the next paper, so I'm happy to pivot now to Francisco's paper.
Nice payback. Okay, so we're going from subnational to international. The next paper is on sovereign debt, and who's presenting? Jeremy, are you? Very good. Floor is yours.
Yeah, I'm going to kick off if that's okay. But the other Francisco Roldan is the master of the slides. He's putting it up. So this is a paper with 3 of my IMF colleagues, Francisco Roig, who just discussed, Francisco Roldan, who will do the second part of this presentation, and Leonardo Martinez. And of course, these are not the views of the IMF. Switch slides, please. Okay, so the basic aim of the chapter is to, give you a sense of a, truly enormous literature, but mainly to make 2 points. The first one is to give readers a sense why sovereign debt is really different from privately issued debt as an asset class, and then why this can have major implications for economic behavior, for macroeconomic behavior. So in some sense, countries can live or die as a result of these macroeconomic implications. And the confusing thing about this is that sovereign debt is different, but it's different in different ways. So depending on the institutional setup, on the legal history, on the size and development of markets, it can have sort of two phases that are completely different, they're diametrically opposed. One is the phase that we're used to in most advanced economies, particularly in the US, where sovereign debt is a safe and liquid asset that, if you like, circumvents financial frictions in the private sector without introducing new financial frictions on its own. And then the other view of looking at it is this is an asset that comes with an enormous friction of itself, namely an enforcement problem, right? And this is the overwhelming fact that many emerging markets struggle with, and that actually most of the literature focuses on number two. And so the aim of the survey is to sort of explain where those views come from and the implications of both, and in line with the fact that the literature on emerging markets is very large, we're mostly with part two. Now let's see if the animation works. Go ahead, push the button, Francisco. Very good. So that's going to be my part, and this is Francisco. Okay, go on. All right, so I'm just going to give you 3 slides. So the safe and liquid sovereign debt literature basically starts from 2 assumptions. One is there is no or low default risk. So this obsession with risk, which is actually most of what the sovereign debt literature is about, is kind of assumed away, and that may be realistic. It may be the relevant case for many countries, and it's clear where it comes from. It comes from the power to tax, and it comes from this idea that the enforcement problem, so the pure willingness to pay problem inside of the government, is solved by domestic political institutions somehow. And then if you then have private borrowing constraints and incomplete markets for private insurance mechanism, then you get this result that buying and selling of government debt in effect can act as a substitute for private borrowing, right? So rather than going into debt when you need liquidity, you would sell a government debt asset that you have bought when you had that liquidity. And one way of thinking about it is that this government's power to tax is kind of a workaround that enables agents to indirectly borrow against their future income after all, right? Because it's the government that will borrow that future income. And so they can sell and buy this asset, then it is adding a dimension of greater completeness to that market. Now, this is a very old literature, but it has been revived very recently because of the situation in which we are in advanced countries where we have very high debt levels. And in many countries, there is no primary surplus in sight that would ever pay off this debt, right? The US, of course, is an extreme example. And so the question then is this sustainable? And if you do not believe that debt has this type of safe asset property, which makes it a valuable thing to hold, even if it doesn't promise, on average, future payments, then the answer is eminently no in the United States. But if you believe that it has this property, then it becomes an empirical question whether the value of the debt stock justifies the sum of the present value of future primary surpluses, which is one thing you get by holding debt, and the present value of these future service flows that have to do with this liquidity provision, right? Another thing that is clear from this equation, which is an extension of what macroeconomists usually refer to as the intertemporal government budget constraint, is that governments get a free lunch, but the size of the lunch is limited to the second term of that equation. So you cannot sort of arbitrarily drive up the value of the debt stock if you are a government without facing a collapse at some point. So this is the message from this literature. Yes, there's a free lunch, but you cannot overeat. Switch slides, please. Okay, so now let's dive right into the other part of the literature. So, the stylized fact is there have been, hundreds, maybe thousands of sovereign default and restructurings in history. So 300 are counted in the most comprehensive and impressive recent paper on this literature, which is coming out in the QJE by Josephine Meyer, Carmen Reinhardt, and Christoph Bebisch. So this is a picture on the left where you see when defaults or restructurings happened, and then the investor losses in this restructuring. So there is no correlation. You're not supposed to see a correlation. What you're supposed to see is that there's sort of these streaks running through, right? They happen to be, for some reason, they're a little bit diagonal, moving up. But the idea is that, defaults happen to in clusters usually, and then you have this enormous cluster around the 1980s, which is the great crisis of the 1980s. You have these size of the dots that reflect the size of the restructurings, how much debt was restructured, and the really, really big blot in the 2000s, the Greek debt restructuring. And then you have the last Argentina restructuring that sits on top of it. Another important stylized fact is that both the size of the haircut and the negotiation period, how long it takes to go from the beginning of the restructuring to settlement, differs depending on whether the restructuring is initiated by the country preemptively before it actually defaults, or whether it goes into default and then starts negotiating. So you have these preemptive restructurings that are much shorter and lighter. Please change slides. Okay, and then finally, my final point, from the fact that defaults are obviously costly for the creditor, we go to the question is what about the debtor side? And so most of the traditional literature on sovereign debt has been obsessed with this question: what are the costs of default for the debtor? And the reason why they were so obsessed with this question is because in the absence of formal legal enforcement of debt across border, the reason why sovereign debt can exist at all hinges on this question of what makes it costly for the. There's an enormous literature on this that has to do with capital market exclusion. This was the original paper that started this. 81, higher borrowing costs, trade costs and sanctions, reputational spillover. So if you default, governments, you worry about your government in more than one ways, even if you're not an external creditor. And finally, the combination of sort of strong institutions and the role of secondary markets, which implies that if if foreigners are worried about external enforcement, they can always sell back to domestic agents, and domestic agents are less likely to get defaulted on because they are voters. There is a very large empirical literature that backs these stories to varying degrees. Maybe the two things to highlight from this literature is that to the extent that capital market exclusion and high borrowing cost matter, and there's pretty robust evidence that this is there, they matter temporarily, right? So you never get banned forever from the capital markets. The rough rule of thumb is you are banned from the capital markets from the moment of default or restructuring, from the beginning of the restructuring until you have settled. And then you regain access pretty quickly. And then there is also a clear effect on borrowing costs, but again, it is only a temporary cost. There's also pretty robust evidence that trade suffers, but no one really knows through what channel. So there's some sort of conflicting evidence on whether trade finance is the reason or whether there are other reasons. And then there's motivated partly by the euro area crisis a decade ago, a new literature that sort of highlights the exposures of the domestic financial system to the sovereign and how that might contribute to the cost of default. So the bottom line then is, what does this all add up to? Of course, the difficulty here is identification, right? Like always, and it's really hard to distinguish the output shocks that might be the cause of debt problems from the consequences of debt problems. And there are some papers that bravely try. They're not perfect, and so I've given you two references here. And the one that I think tries the hardest is this paper by Kushinov and Zimmerman, and they argue that there are indeed default costs over and above the costs of debt crises that trigger these defaults, that they peak at 4% of output after 5 years, and then they dial down. So these would be temporary output costs. There are other papers that say, oh, this has temporary growth costs, but actually the output is. Let me stop here and hand over to Francisco.
Let the record reflect that the senior co-author used 2/3 of the time.
Thank you. So thanks, Jeremy. I'm also very, very grateful to be speaking at the conference. And also, in case anyone was wondering, I'm not going to explain the IMF's views either. So I want to jump in the issue of sovereign risk and start off by making the simple observation that this is all a literature that's about one thing that's not observed, which is the probability of default by the government. All right. And so what do people do? They look at spreads. So they look at bond prices to try to infer what are expectations of investors. All right. So very simple. If you have a bond that promises some repayments D in the future, it's got a price Q. What you do is you try to find a discount rate such that the present value of payments equals the debt price. Okay, and I'm focusing on this for a second just to emphasize the issue that you can only do this in a model-free way if the payments are non-contingent, right? If as soon as payments are contingent on some variable, you have to take a stance on what's the distribution of that stochastic process or that variable in the future that's going to create the payments. To the extent that it's not, you can match different bonds, for example, a German bond and a Spanish bond, and one of them is going to be considered risk-free. And by comparing the spreads, you can figure out by comparing the interest rates, you can figure out what you call the spread. And most of what's in the spread is the default risk, but also other things are in there, which some sub-literatures have studied. You have liquidity premium, you have ambiguity premium if you think that the investors have concerns for robustness. There's risk aversion waves, there's political economy considerations, all kinds of different things that some parts of the literature have tried to take out from these spreads. So these spreads are important in part, kind of like a sanity check, because they spike right before government's default, which gives you a sense that these spreads have something to do with the default probability, which is what the literature is really after. And so these spreads correlate also with the instances that Jeremy was alluding to, instances where governments actually default. And so we spent some time surveying when resources make spreads go up, or the borrowing costs make spreads go up, or political factors. And here I want to point just to little things. The first is the issue of strategic complementarities, by which governments might want to use their borrowings today to influence the choices of future governments down the line. And so that turns out to be quite important in this literature for different reasons, one of which I will allude to at the end. Also for idiosyncratic reasons, I want to point to the issue of reputation, which seems to be important in more ways than one. So what I want to focus on in this presentation maybe is the issue that maybe motivated by the Euro crisis, but also coming from before that. There's this idea that default risk is a problem not only because of government default and the consequence of government default, but also because there are costs imposed to the economy just because the debt of the government is risky itself. All right. So again, this was partly motivated by developments in Europe, where Greece, or not Greece, but Spain, Italy, Portugal, Ireland had a period where it's broadly understood that default risk had something to do with how bad the economy was doing. And so there are a list of channels through which sovereign risk affects the economy, and these are all literatures, recent literatures that look at these issues. So the first point is that if spreads go up when the economy is doing badly, you get countercyclical spreads. These curtails the possibility of borrowing in those bad times. So they make fiscal deficits procyclical, and so you get a procyclical fiscal policy that cannot lean against the cycle. So that's one. Disables one of the tools of the government to alleviate the business cycle. That's thing number one. And more, but this is kind of a mechanical thing. There are more subtle ways in which sovereign risk affect the economy, and these are all through these public-private interactions. Right? So the first and foremost is this idea of the sovereign bank nexus, which Jeremy just alluded to, where if domestic banks hold sovereign debt, then the riskiness of the government just affects the banks directly, and the health of the banking sector, of course, affects the government in general. So there's this feedback effect between banks and the government, which in the case of Europe was extremely important. The second thing is this idea of that sovereign risk itself because of its consequences, because default is actually possible, increases the precautionary behavior of different agents. So think about banks or investors or consumers. And through these channels, it first creates pass-through of sovereign risks to other borrowing rates in the economy, but also just affects the size and the composition of investment, what projects get funded, fewer of them and probably less risky of them. And also, to the same vein, vacancy creation and just directly aggregate demand is kind of lower when there's sovereign risk. And this, yeah. So the last thing I want to point out here is that this is evidence from the graduation literature, where countries that increase their institutions might jump from the top panel here to the bottom, where I was plotting emerging economies which have a negative correlation between interest rates and GDP growth, to developed economies that have the opposite. And so by increasing your institutions, it looks like you can move from one to the other. All right. So in the next just 2 minutes, to not eat too much into our discussions time, I want to talk about, so if sovereign risk is so bad,
you're taking some liberties there.
I'm going to take 1 minute, no more than that. But I really want to stress this point. If sovereign risk is so bad, why do governments do it, right? And so there are kind of 3 pillars here. The first pillar is that markets are incomplete. And so because if you issue debt that's non-contingent and promises repayments across the board, no matter what happens, you're bound to expose yourself to not repaying in some states. But on the other hand, there are also these 2 forms of lack of commitment. The first one is that you can't commit to repay your debts. And the second one is that you can't commit to future borrowing of the same government or other governments of the same country in different, which kind of goes back to the strategic complementarity I was talking about. And this is, I want to mention that strongly, because it turns out in this literature that this third point is actually very important. There's this issue of debt dilution, which comes from the fact that debt is long-term. And because debt is long-term, the prices depend on future prices of government debt. And because they depend on future prices, they depend on the expectations about future borrowing decisions. All right. And this feedback creates a timing consistency problem, which creates over borrowing and leads to government exposing themselves to sovereign risk. All right. So what can you do? There's different things we talk in the paper about fiscal rules and using state contingent debt to mitigate these frictions, really. And so I'll stop here. This is all from me. Thank you so much. I
appreciate that. Thank you. And Dan is going to do the reciprocal discussion.
Let's see. Can you hear me and see my screen now? Give me a thumbs up if you can.
Yes, sir. Go ahead.
Great. So I'm thrilled to be able to talk about this really excellent work. As the author said, it really is 2 very nice papers in one. The first one a little shorter. Part 1 is safe sovereign debt, and part 2 is on external default, is the way that I might frame it. They're both interesting. I'd say, the part on safe sovereign debt, if I could just add my own exclamation point to how important this is, there are some concerns now about how exactly things are going to work out with the intertemporal government budget constraint in developed countries, in particular in the United States. Is our current level of debt inconsistent with the future primary surpluses that we can expect? And I think this is an incredibly important question. I think that, my takeaway from a lot of the recent literature on this is that there is, a sovereign, and in particular a sovereign whose debt starts to be accepted as an asset that's going to provide a liquidity service, can violate the narrow budget constraint because their debt provides a liquidity service. But as a point that, certainly this is an elegant paper that makes that point. Liquidity is very delicate, and the transition away from dollar hegemony may be very unsmooth. That is not a smooth transition away from that regime. The only thing, and it's just if you think about the habitats of academic researchers, there's a habitat of international public finance folks, and there's kind of a habitat of like Social Security folks. And as somebody who's not really part of either of those habitats, looking at it as more of an outsider, in a lot of places, certainly in the United States, our pension and retirement obligations completely dwarf the explicit bond market debt. Depending on how you value them, you're talking about a factor of 3 to 4 larger than the bond market debt. And so I think that would add to the urgency of this type of question, and the politics of adjusting all of these claims are likely to be unsmooth. In the United States, these claims are explicitly state contingent. So as we think about, state contingent, the mystery of the non-existence of state contingent government debt, I think that Social Security payments are tied to wages over time, and so that's an example of state contingency in the form of government debt that is held by the retirees and the workers in what is now the hegemon. The heart of the paper is on external sovereign default. I think this is an extremely useful survey of the literature on that. In the background, I think, is kind of a looming question. Do we need some kind of a new formal mechanism for restructuring sovereign debt? Because the world is changing in a lot of ways. Any discussion of restructuring, you've got the risk of making things too easy to restructure, where you have too much incentive for ex post default that will make it harder to borrow ex ante. Like if you can, you lose the ability to finance useful infrastructure if everybody knows that you will default ex post. At the same time, it's possible for relief to be too hard to access. It's also possible for in a world community to do too little, or to do not enough to restrain creditors' competition against each other. And I just want to highlight, in the background here, there are some really interesting recent events. And it's funny when the IMF folks say, okay, this is our views, this is not the institutional view of the IMF. But the IMF does have a view, and it's a view, honestly, that I'm super sympathetic to. And you may have followed, there's this interesting case where an American hedge fund bought some Argentine debt. Argentine debt was being restructured. An American hedge fund basically got, there's a technology for being a jerk about things. And a lot of what we call technology is just imagination. And there are things that just sort of said, hey, why don't we do this? They got a Ghanaian court to seize an Argentine naval vessel, and they got, American courts blessed it. And that basically, so there is an evolving playbook for how holdout creditors can throw wrenches into restructuring processes that it's not there. Certainly the American courts blessing that wrench throwing is, as a surprise, has been sort of a change in the state. But what has happened basically is that people have become much more imaginative about breaking pre-existing social conventions, about not being, jerks about things. So the world is changing. There is some waning of the ultra preeminence of the United States vis-a-vis sort of other sovereigns, vis-a-vis its own citizens. There is, and as we think about potentially changing in some ways the international convention about the rules for restructuring, or the rules of the game that will govern the restructuring of sovereign debt, it's worth noting, that China is increasingly a lender in a lot of developing countries. The scale of their lending is a little bit, I'm less confident about the data there on kind of the scale of Chinese lending. I'm also I think that it remains to be seen as we get into, how imaginative will China as a lender be about either breaking down or reinforcing the rules of the game here. if you think about, and this is maybe a dangerous analogy, but if you remember from a different market, if you remember the collapse of long-term capital management, right? So, 1998, you have long-term capital management get in trouble, and the New York Fed sort of got all the major counterparties, except Bear Stearns. Sort of, Bear Stearns said, we don't care, but the other major counterparties all got in a room and they kind of hashed it out, right? And if you think about the rules of the game or the way things worked in the 1980s, the bond market versus the loan market, it was much more lending from banks. It was all people that were sort of in the same Rolodex, and the world is really, really changing. And I think that the technology of holdout, the holdout technology is evolving. Now the evolution in the technology of issuers to deal with holdouts, the sort of arms race of technology. So an issuer can can make sure that their debt has collective action clauses that will, force restructuring onto holdout investors. But I think that the ability to go back to a world where you will have, consensus among creditors, at least that they are playing the same game, like that they are sort of part of the same community that respects kind of the same game, I think is, it's an open question whether you can restore that. I think also that you have just more and more financial engineering technology that allow you, in some cases, it is possible to offer state contingent debt, whether it's based on climate, based on weather, based on oil. The other thing that this will do is that I think that we should look forward to a world where issuers become increasingly imaginative about shrouding their debt issuance. Like one thing that jumps out about Greece, and as somebody who was sort of sitting in a university just watching from afar, was that the extent to which they used some swap contracts to accomplish the substance of borrowing while being to some degree shrouded. And I think that the social conventions that, and I think the conventions of lack of imagination that make that something that people just don't do, I think continue to break down. And so this is a timely look at something that has been interesting, has been complicated, and that I think will continue to give economists interesting things to think about. So a very good and useful chapter.
Super. Thank you for that. And let's turn it to the floor. You could unshare. Kosuke. Oh, you're still here. Wow.
Yes,
okay.
I'm still awake. So it's a great paper. I enjoyed it a lot. So I have a question about currency denomination of debt. Okay. So the choice of currency, does it affect riskiness of bond? And is there any data or theory that supports this kind of issues? And also, I want to see some examples of debt which was regarded as safe, but it became risky, and vice versa.
Let me add a bit to the wish list on in a sense the bond covenants in sovereign debt issuance, in that some debt is issued subject to Paris Club rules, some debt is issued such that arbitration is in London or New York. Some debt is issued such that the issuer is also the arbitrator, so to speak. It's the issuer's courts, right? And some debt is properly foreign debt, some is foreign currency debt that is sold to residents, and those distinctions, not necessarily pricing, but how the market, pricing is obviously important, but how the market is structured to distinguish and sell and settle this debt is an interesting question. Okay, and we have a minute.
Should I quickly react?
Please do.
Right. So first, we're extremely grateful to Dan for really nice complimentary discussion and for being supportive of the paper. Now, there are many things missing in the paper, and it is indeed, we will have to make a choice how many to bring in. But the two that you both mentioned are ones that sort of were on our list for discussion. So there is indeed a large literature and evidence on currency mismatches, so balance sheet mismatches contributing to sovereign risk. And there's also an extensive literature on why these currencies mismatches might arise. And they have to do with some deep distortions, moral hazard, institutional credibility, monetary policy credibility. So this is indeed something that could be added to the sovereign risk section. So we, if we get an indication from the editor, we will do it, but we will also discuss it among ourselves. The other area where the paper is short on is in something it's very short on the areas that are very central to Dan's paper, which is essentially on the mechanics of the market, right? So, governing law, on the legal structure. I have another survey that I published about 12 years ago that it goes a lot into these legal things, and we've left it out here for a space reason, but we could bring it in some more minimalistic fashion. In part because
I'm happy if you just refer to
role, I think at the last decade. Yes. And related to that, we could also, I mean, if you maybe, Refed, you can reflect on that. And I was meant to also ask Dan, do you think we should say more about, the holdout problem, debt restructuring, governance, the common framework, these sorts of things, right? They have not really been discussed. So in the default section, this is a page with the main stylized facts, but we haven't really gotten into the debt restructuring stuff because we felt there was not enough space for it, but maybe people want this because it is so much in the news. So it's essentially it's your choice. It's the editor's choice.
Well, I think what people want is infinite, and page resources are finite, and there is a discipline that studies such problems. Okay, wonderful paper. And now, when especially in the US, one says financial markets, the market that comes to mind shall be presented. We have Caroline to talk about the equity market.
Okay, I'm going to see if I can get this to present.
Yeah, we see your screen and we hear you.
And it actually went into presentation mode, so that's a bonus. Well, thank you for inviting me. This is a gigantic topic and second to last slot. So I'm going to try to get this done in 15 minutes and get your feedback, which I'll look forward to. So equity trading, yeah, it's a huge area. And of course, there's any number of different topics I could have covered. I'm going to cover what's here in the list. And I won't read them all to you. So since we're short on time, I'm going to try to hit the highlights. I won't give you much of a background since most everyone's pretty familiar with the stock market. So I'm going to focus on what the big issues seem to me to be and where the research is at right now. Of course, everybody is pretty familiar with the buy side versus sell side differentiation in equity trading. On the buy side, what I think is probably the most interesting new area of research is how retail traders are coming into play more and more on the one hand, and how hedge funds and high frequency trading firms are affecting markets on the other hand, and this interplay between them or among the different segments on the buy side is a fruitful area of new research. On the sell side is more about the platforms and how trading takes place, the microstructure, auctions versus over-the-counter, matching, different kinds of mechanisms. And then, that does interact, of course, with who participates in markets, but it has a lot to do with the technology of trading, where people trade, and that brings in the issue of on markets or off markets, the lit or dark pool trading. And so there's a lot of research going on dark pool trading where trades are pulled off of exchanges. And then the welfare effects, and a lot of that has to do with liquidity in the market. The next step, of course, after you execute a trade is the clearing and settlement. And this just on its own is something that, you know, your average person doesn't think about, because it's like the plumbing. It's often actually, that's an analogy that's quite often used, is the plumbing underneath the trading. So you see the trades that go on, and you look at the transaction prices, and it's all about the execution. But the clearing of trades and the settlement of trades is where a lot of the action actually takes place, and where a lot of technology has come into play. It's really quite interesting, and I think most people don't really even think about how long it actually takes to settle a trade. And really, it was for centuries. It was about 2 weeks for most markets. The New York Stock Exchange was the early mover on speeding up clearing of transactions, and was quite unusual in requiring overnight clearing. Most other markets required fortnightly clearing and settlement. And there's this really interesting, cool work by Dutch economic historian Codice, who's got this paper. I think that's actually in the JPE. He has a couple of papers related to this topic. So of course we went from boats to computers, but it took a very long time to get there. And even with the New York Stock Exchange being very early, it wasn't until 1920 that they initiated daytime clearing on the New York Stock Exchange. And then it wasn't until the mid 70s until we got the Depository Trust Clearing Corporation in 1976. In the advent of computerization. And I talk about this in the chapter, and I can go into it more if there's interest in that in the chapter. But you know, the advent of computerization after World War II, really in the 60s, caused some severe problems in these clearing and settlement procedures, and they literally would have to shut the market. At one point, it got to the point where it was like every Wednesday they would shut down the market just to clear and settle orders, because it was just this overload. And there were actually a lot of failures of market participants during that time because they couldn't keep up with the clearing and settling. Now, I think the most fascinating new area in this is the blockchain technology that could offer nearly instant settlement, even while remaining bilateral. And there's a new company, Paxos. Actually, it's not even that new. I looked on their website last night, and they've been around since 2012. And it's a bunch of very young-looking people on bikes in their, their like team, corporate team photo. So if you want to go work for Paxos, get up to speed on your like mountain biking. So, and like reverse age 20 years. So it looks like, they have like real serious customers, like I forget but big banks like B of A and Credit Suisse or something, UBS maybe. So they're very serious, and they even have a basically a "we're not going to bother you" letter from the U.S. SEC. So they seem to be doing things right, and I think this is a new area that is going to need new research coming up. So okay, now when we think about trading and even the clearing and settling, we think about frictions. And frictions also relate to the trading costs. So we worry a lot in market microstructure about trading costs. And that happens not just from the rules like tick sizes in the trading prices, but also in the technology that's used. So we can see long-term trends in tick sizes or changes in tick sizes have had a big impact on the bid-ask spreads in the market. So when tick sizes, that is the price increment, has been exogenously reduced, so have the bid-ask spreads. And there's a lot of research on that. and there have been some tick-sized pilot programs. And of course, it's been technology that allowed markets to move to decimalization. It would have been way too complicated, 100 years ago to compute everything in decimals. So that's why it was done in eighths originally. And in fact, the majority of trades were done in even eighths. Previously, so it was like basically quarters. Then there's related issues like payment for order flow, and I'll talk a little bit more about that later, and algorithmic trading and high frequency trading, like latency arbitrage. And this is probably the biggest area for new research because the issues of speed in the market have really taken over. And you may be familiar with like the microwave transmission of quotes and trades and so on, and communication. And the problem of latency arbitrage, where high frequency traders are taking advantage of speed advantages and profiting. And there's an estimate, I think it's Aquilina et al. Have an estimate of about $5 billion of cost, and that just eliminating latency arbitrage could reduce transactions costs about 17% globally, $5 billion globally. So that's not just the US, it's a global phenomenon, and very expensive. So that's an area that I think is interesting to be researched. Okay, so then when we think about equity markets, we also commonly think about how they impact the real world. Every day in the US, you hear about what the stock market did, right? And there's a lot of kind of just knee-jerk reaction to the stock market because we think it has an impact on the real economy or somehow reflects the real economy. And so that's a whole other area of equity trading that I've looked at, and it has a very close connection to credit markets. So there's a lot of interesting work. A lot of it came, it's been stimulated by the famous paper by Brunemeyer Peterson in 2008, which was really kind of a theoretical idea, and had a lot of had several, about 5 different kind of empirical implications, and the research has continued on that front to show that it is in fact a valid kind of theory. I think it also is interesting to think about how those liquidity freezes spill over into the real economy and recessions. And there's a recent paper by Bianchi comparing the effect of stock market crashes in the Great Recession and the Great Depression. And he's showing that basically the Fed learned from the Great Depression, and seems like their intervention in the 2008 crash prevented that stock market crash from turning into as big a depression as the Great Depression. So that's an interesting area of research. Also relatedly then is, well, so we think the Fed can intervene, or monetary authorities can intervene via the credit markets, and the Fed has been to provide this real benefit, but at the same time that causes a moral hazard problem, as we've all seen in the 2008 episode. And you can see what the big Wall Street banks have been up to since then. So there's a lot of excessive risk taking. So that's a bit of a problem. And then I'm just highlighting here the funding market data that I've collected on a daily basis, which was kind of like the repo market of the day that was collateralized by the stock market, or stocks that were traded in the New York Stock Exchange. Okay, regulation. I have very little time to go over this, so I'm going to leave that for you to read on your own. Obviously, everything the stock market does is now regulated by the SEC and also by FINRA in the US, and by regulatory bodies all over the world. So that's a gigantic area for research. One of which is how they're going to regulate the democratization of finance and blockchain, which are the 2 areas I highlight as needing a lot more research. There is a lot just starting, but it's really pretty new, and there's huge room for more research on issues like the retail investors and what role they play in the market, and whether we should regulate, whether we need paternalistic kind of regulation on them, whether it's just a matter of there's a lot of opacity in those markets. So that's I think a giant area for potential research is the democratization of finance. And really relatedly, and there's a ton of research, and a lot of this, I will just say upfront, I do not fully understand the computer science behind blockchain. So, it's something I can't really explain to you if I had to, but I can tell you how important it is in financial markets, and that there's a lot of research on the effects of it. And then how it's going to be regulated and taxed is a really important area. As I mentioned before, Paxos on settlement, but also just on creating contracts. Are these equities? A lot of these we think of cryptocurrency, Bitcoin and so on are the famous ones. But they really are also, these tokens are actually quite equity-like. And so there's a lot of financing of new enterprises that are going on through tokenized equity. And then trading on these exchanges. You can go and look at, blockchain. There's a whole website of exchanges, and there's just dozens of them, maybe hundreds of them, where they trade. So there's this whole other area of equity trading that's under blockchain and tokenization, and really just starting to be researched. I looked in the Journal of Finance, Journal of Financial Economy. I looked through the finance journals. There's very, very little research. So that's an open question. And last but not least, with my final minute, I'm going to put in a plug for historical research. There's actually burgeoning research in historical equity trading and related topics. I encourage you to break out of the Journal of Finance and read some of the historical work that's going on. There's a massive data project on European stock markets funded by the European Science Foundation. I think it's called that. I'm actually participating, going back to my days of working on the German financial system, and have a project on the Interwar Berlin Stock Exchange, which is very exciting. And many other researchers across Europe are working on the exchanges of Europe historically, and hundreds of years of data. Then myself, I have a major project funded by the NSF, collecting basically like a CRISP database back to 1900, and it's been linked to CRISP, and that's my timer. So if you're interested in any of that historical work, it's ongoing. I have several papers related to equity trading, which you can see there. Yep, so I'm out of time, but there's my conclusion.
Super.
I look forward to your input. I guess I'll put it this way. I left space to expand, is a nice way of saying I didn't quite get 100% of it written yet, but it's therefore open to comments on where to elaborate or where to add topics.
Excellent. Thank you for this. And I admire a presenter with a timer. I also admire this paper. And somewhere here are my slides. There we are. Now let's make this full screen. Okay. So other than pleasantries, I think the unwritten but main comment that I have is that it would be wonderful if this paper moved in the direction of the presentation. The presentation touches upon a lot of the things that I put here as avenues for expansion or questions, and so I thought the presentation actually exactly has the right tone. And it's the point is, I am the discussant of last resort, and I don't know equity markets all that well. But now I feel like I know a lot better than I did, because this is a really informative paper, and thank you for that. Now, as you also noted, there is scope for expansion, and I also thought Some things I knew, but I thought, these aren't obvious. Actually, you're using them, but we'd like these chapters to be more accessible. And some things I actually did not know. I'm not going to tell you which one is which, but I'm going to just say, here are some questions. Okay. And the last thing is, and this is something that many discussants brought up for many chapters, but especially given there is scope, maybe there is space for a little bit on pricing, not necessarily a discussion of here is how pricing is done, but at least pointers to the literature and basic ideas. Okay, so it begins with, so we talk about margin lending, but then it's not clear. It's clear who the borrower is, but it's not clear who the lender is, right? So there is some scope for talking about these. You talk about short exempt investment. This one is actually one that I don't know, right? You talk about covered short selling, and that for most people, I think, would require a definition, and that definition would also get into the beautiful naked short selling. Right, and that it used to be okay. It's now quasi illegal, I guess. Right, things of that sort. But I guess these are chapters that are written for our grandmothers, and the grandmothers are not expected to know covered short selling and things of that sort. So one thing that I really, really do want to learn, and for the life of me don't get, is payment for order flow, which sounds like we make a loss on every item, but we make up for it by volume. And so, again, the paper didn't have much of this. It's just there in a sentence, in the sense of, my father has payment for order flow. But Robinhood also is touched upon briefly in passing in a sentence. But these are really interesting things, and I think you are the right person to write about them. So, before the presentation, I was thinking, wouldn't it be great if you talked a bit more about the market maker, market taker, in particular about Robinhood, what it brings, how it functions, what its implications are on tokenization. I think equity market is probably the most obvious place where this is going to have an impact, right? And then, in the more civilized parts of the world, it's a usual, dinner talk and making fun of the US for T+2 settlement. And I thought that was always that. But I learned from this paper that New York Stock Exchange used to do intraday clearing. And then with corporatization, they moved to T+2 clearing, which kind of sounds counterintuitive to me. Right. So some discussion of that would be very welcome. Is it that the computers were so bad that they had to move from intraday to T+2? And if so, why computerized to begin with? Or is it that there was a need to have same kind of settlement across different exchanges, but that wasn't the case before, so why then? But that seems to be a nice history question that is worth answering, right? The other bits too, right? Things like the morning call auction at the New York Stock Exchange. This is an artifact of actually having business hours, right? But talking about it a little bit is useful. Kind of used investment banks marketing the IPOs and underwriting IPOs as interchangeable things. And I don't know whether they are, right? Similarly, around there is a discussion of regulation and lifting of the leverage ceilings related to Bear Lemon and all that, but it doesn't seem like this is equity trading related, right? It's just leverage is leverage. And equity trading leverage, is that on its own right something that we should be fearful of, we should be thinking about? I really want to know your take on that. Dark pool trading is, so thinking about what I don't know about that made me realize how much I don't know about other bits of the equity trading. In particular, who keeps the ledger, right? I understand how you would have a dark pool where you're matching people, right? Fine, and somehow I did that, but these aren't the papers that we are transferring among each other's anymore. So there has to be a way of this dark pool having access to some ledger that says, okay, these assets that used to be owned by this person is now owned by that institution, right? And how does that work? So this kind of, I think this paper has just the right balance of historical curiosities and things that keep you entertained and you keep reading the paper, and that's beautiful. But also you learn a lot. And most of these questions are, would you have a plug for this? Would you talk about that a little bit? That too. The one substantive thing would be, especially if having done all of these, if you still have space, maybe a little bit on pricing, and saying, okay, here's the stupid way of doing this, the Gordon growth model, but then you would have to think about, but the Gordon growth model is a good way of talking about bubbles too, right? Then bringing in something like FAM and then saying, go read these papers if you're really interested in pricing. You may or may not want to do this, but that's what I had. I learned a lot, and I thank you very much.
Thank you.
And this is where I unshare and ask who has questions or comments.
Yeah. Thank you for those comments, and hopefully you'll send them to me because I didn't get everything written down.
I will do that as editor rather than discussing, but yes, of course.
Yes, okay.
And in fact, everybody will receive the discussion.
Okay.
There is one in Q&A that I will read without really understanding.
Okay.
As the share of algorithmic trading soars to unprecedented levels, do you think that trade execution mechanisms may be reconsidered? For instance, can frequent batch auctions make the trading parties race for better pricing rather than race for speed in order execution?
Yes. I think the answer is yes. So I think algorithmic trading is that this goes under the category that I was talking about, technology of transaction costs, or technology and transaction costs, and the high frequency trading. So there is definitely, this goes with the speed of trading. So what he's saying is the trade execution mechanism may be reconsidered. I don't know if he's talking maybe about using some of these new blockchain technologies or other computer technologies. But I think for sure the computerization end is where the technology is, or the coding of the computers is where the technology is rapidly changing. And so I need to look into that myself to really give a good answer of how exactly that's going to affect. Because what I was talking was more about the settlement, the clearing and settlement, but the actual trade execution could as well. And that gets to your issue of the dark pools. But all of that, the New York Stock Exchange stocks, which is the biggest, and NASDAQ, goes through the clearinghouse, the DTCC, and its various subsidiaries. And so in answer to that question about dark pools, I think that would go through, even those trades still have to get cleared and then settled. So I would have to look into that, the details of that plumbing. But yeah, so the question here though is more on the execution side, and that is an area that again, like I said, I need to look more into that to know about the computer coding of that, because it's about the software, well, and the hardware. I mean, it's about the computers. So yeah.
All right.
There's not very much research on it is the answer. So it's more like on the practitioner side.
I think one of the things that all of these chapters are doing very nicely is bringing up avenues for further research. And that's the sense in which this is a research handbook. So very good to point that out.
Well, one thing that this points out is in researching for this chapter is I had to get up to speed on some areas that I was less knowledgeable about, including blockchain, but I just got very fascinated by it, and it is really the forefront. But what strikes me is that we need to have more computer science capability in financial economics. And at Emory, we just started a joint major with economics and computer science. And I think that's also going to be the future.
I wanted to have a chapter on this, but Jonathan said that blockchain thing will never hold. So I said, okay.
Well,
all right. Excellent. Of course, that never happened. But last and very hopefully not least is the chapter on futures and options, and the better quarter will present.
Okay, do you see my slides?
We see your slides and we hear you.
Great, thank you. Okay, so it was great fun working with Rafet on this book and on this chapter. So the outline of our chapter on futures and options is we first of all talk about the history, and it's a very long history going back literally thousands of years. Types of futures and options traders, open outcry in electronic trading, regulation, pricing and usage, and then certain specific futures and options contracts and their usage. And I'm not going to talk through all these parts in these 15 minutes. I'm just going to pull out some pieces from the last two parts to showcase interesting and topical uses of futures and options. So one of the things we want to do with futures is to reverse engineer expectations out of them. And that's fine. And they are expectations under risk neutrality, but in general, there is a risk premium. And the way that people try to assess, or a way that people try to assess risk premium in futures contracts is they take the futures price at time t, maturing at time t plus h, and the realized spot price at time t plus h, and then regress that difference, that's the futures pricing error, on stuff that was known at time t, like the futures price itself. And no risk premium corresponds to the coefficients in that regression being zero. A constant risk premium would be an alpha being non-zero, but beta being zero. And when people have done this kind of regression for all sorts of futures contracts, and in general, the rule is they find statistically significant risk premium and time-varying risk premium. The exceptions may be for energy futures like oil futures, and perhaps for very, very short-term interest rate futures. Now, from the point of view of trying to reverse engineer expectations, risk premia are a nuisance. From the point of view of investors, risk premia are exactly what's attractive about futures. And there's a fascinating finding documented by Gorton and Ruenhorst and others that commodity futures returns have average properties and risk properties very much like stocks. So it's like a stock type asset in terms of average return, standard deviation, Sharpe ratio, but they have a negative correlation with stocks. So from a CAPM perspective, this makes it really attractive. And indeed, that is that sense is what led to an increase in using commodity futures as an asset price in its own right. There's some evidence that the correlation with equity returns has increased since the global financial crisis. So I want to talk about a few uses of futures contracts. One very important one is measuring monetary policy surprises. So the original paper in this was by Ken Kuttner, who used Fed funds futures from just before and just after FOMC meetings to measure the surprises in the funds rate target. And those are still very widely used Kuttner shocks. Gerkeinek, Sack, and Swanson looked at jumps in a whole range of futures prices around FOMC announcements and found that there were two dimensions to it, which they rotated into the Kuttner shocks and path surprises, with path surprises actually being bigger. So the FOMC does more telling you what they're going to do next time, but doesn't really surprise you about what they're doing this time. And then these have been updated to the era of unconventional monetary policy, where there's three or more dimensions to policy. For example, Swanson talks about a target surprise, a forward guidance surprise, and an asset purchase surprise, with the names coming from the loadings of these surprises on different factors. So it's now standard to use these to measure the effects of monetary policy surprises. So there's a question then about what these monetary policy surprises identified from jumps in futures prices around FOMC announcements really are. We typically try to think of these as exogenous shocks to the Fed's reaction function. but there's some evidence that tighter than expected monetary policy surprises, tighter than higher than expected interest rates, so identified, actually end up increasing output growth forecasts and inflation forecasts, which is the wrong sign. And so people have suggested that there may be some information in these shocks. It may be that the Fed has private information, and by its decision to tighten monetary policy, it's let the cat out of the bag. I am skeptical of the idea that there's a big information component in monetary policy surprises, and there's recent work by Bauer and Swanson on this question. Now, futures can enhance liquidity, but they can also contribute to financial instability. They can be a double-edged sword. And there's a recent paper by Barth and Kahn that noted that hedge funds before COVID were all piling into a basis trade where they go short treasury futures and long the underlying treasury cash and finance it in the repo market. And in March 2020, they faced losses and margin calls on this trade, and that contributed to the turmoil and would perhaps have been much worse if the Fed had not stepped in. This ties in a little bit to some of the comments that Hyun was making earlier. One great use of options is that they allow us to measure the risk-neutral probability density. So the cool result is that if you take the call options price as a function of the strike price and take the second derivative of this, this is the risk-neutral probability density for the underlying. So here's an example of a risk-neutral PDF taken this way. It's of the pound-dollar exchange rate 3 months hence as of June 23rd, 2016. An infamous date that was the date of the Brexit referendum. And this PDF was taken from market prices before the result was known, and you see in that a clear skewness towards negative rates. So the traders in currency options were at least aware of the downside risk of the results of the Brexit referendum. And you can see that from this. Now, risk reversals. Actually, risk reversals tie very much into that kind of currency option. A risk reversal is a portfolio where you go long and out of the money call and short and out of the money put, or vice versa. So it's a bet on which tail is more likely. And so risk reversals are like options-based measures of skewness. And these risk reversals have been used to give an explanation, or at least an accounting, for the well-known failure of UIP and the profitability of the carry trade. It turns out that these options-implied skewnesses are strongly related to interest differentials. So in other words, it's saying that a trade like borrowing in yen and investing the money in Australian dollars is indeed profitable on average, as in the violation of UIP, but it's compensation for the fact that you will occasionally lose a lot of money on that trade. So you're more likely to face a downward crash in that carry trade than an upward one, which is an intuitive explanation for the failure of UIP. There are options also written on CPI inflation. And these got going around the time of the Great Recession. Their liquidity has waned a little bit since then, but it's still a live and active market, which again you can use to get a probability density function for inflation itself. And at some times this has been skewed towards higher inflation, and at some times it has been skewed towards deflation or very low inflation. So this gives us something that is quite interesting from a central bank perspective, because the narrative of whether we're more worried about high inflation or suffering an outcome like Japan has had, that's all very important from a central bank perspective. There are options on both stock indices and on individual stocks. And comparing the prices of these options can actually be used to give you a measure of correlation. And that was studied in a paper by Dreesen and co-authors. And Brian Kelly and co-authors have an exercise of comparing out-of-the-money put options on individual banks and then the corresponding out-of-the-money put options on the financial sector as a whole. And they find that the relative value of the index options fell after the crisis, which they interpret as saying that after the crisis, although an individual bank could still get into trouble, that there was a too big to fail implicit guarantee on the financial sector as a whole. And they're trying to measure that directly from options prices. Now, in principle, the famous Black-Scholes formula, which reverse engineers volatility from options prices, uses replication pricing. So there's nothing about preferences in there. It doesn't matter how risk averse you are, the option is in principle a redundant asset. But that's only true under the assumptions of Black-Scholes, the technical assumptions, which are that everything is a constant volatility or a known volatility diffusion. So with real world features, the gap between the implied volatility, think the VIX, and the actual volatility is a function of risk aversion. And that's something that you can attempt to measure on a day-by-day basis. So on average, the Black-Scholes implied volatility is on the S&P 500, it's about 22% per annum. The physical volatility is 16% per annum. So there's a risk aversion, but that spread changes over time. And so this idea of measuring time varying risk aversion is another very important use that people have made of options. Ian Martin at the LSE has a lot of very creative uses of options in recent papers. And one of his recent papers shows how to use equity index options to construct a lower bound on the equity risk premium. And this lower bound averages about 5% per annum, but it can spike at times like the Great Recession or COVID to very high levels. So it's a bound. And of course, if we had a bound that said, well, the equity risk premium has to be bounded below by 0, that wouldn't be a very interesting bound. But the fact that the average lower bound is around 5% suggests that it may be close to a sharp bound, and it may actually be giving us a measure of the equity risk premium or a good indicator of the equity risk premium. So that's a very nice use of options. So open questions. What are the risks to financial stability from futures, and how can those risks be minimized? It's a very important thing that despite all the financial turmoil there has been, the clearing houses in futures have never failed. We can talk about refinement of term premium estimation in futures. We don't really ever have options on macroeconomic variables that are not asset prices in their own right, like GDP. Schiller would love to have those. I think they would be fascinating to have. It's interesting to think if we ever could have options on GDP. And there's open questions on the uses of market-based surprises like monetary policy surprises as instruments. We try looking at these as external instruments in VARs, and of course we can easily identify these monetary policy surprises. But once you have a large number of them, then questions of weak instruments that are near and dear to my heart come up. So there's expanding availability of futures and options, and this, coupled with the ingenuity of economists, gives us a rich source of information. This can answer questions that are of broad macro interest, not just narrow asset pricing questions like, are financial institutions too big to fail, or what are the risks to inflation? The general limitation, though, is that they're answering questions under the assumption of risk neutrality. And I'll leave it there.
Wow, what an interesting super paper. Let's see what the discussant has to say about it. If you want to share your slides, yes, please. Yep. And Binwei is going to discuss. Bin, you are muted.
Sorry, can you see my screen?
We see your slides and we hear you. Go ahead, please.
Perfect. Yeah, so as the last discussant of the last paper, I want to take the opportunity to thank Raphael and Jonathan for organizing such a great conference, and also, for editing this great handbook. So it's my pleasure to discuss this chapter on futures and options by Raphael and Jonathan. So the usual disclaimer applies here. So this is a really nicely written and informative handbook chapter on futures and options, and I learned a lot from reading this chapter. So this chapter is, covers a lot of aspects about these futures and options. It, talks about what are the types of traders, talks about how these futures and options are traded, and also talks about clearing and the regulation, pricing, and also talk about, importantly, about the specific contracts and also the usage in the academic literature. So my comments today is mainly about the usage of these futures options in the academic literature. So the chapter highlights three main uses of futures and options in the literature. So the first one is that the short maturity futures are used as a placeholder for the underlying asset. So could be for different reasons. The first reason is that the futures have more accessible intraday prices, right? So one example is oil, right? So oil prices, we observe daily prices, but we don't really observe the intraday prices. But the futures can provide us with that. And the other reason is futures may have different trading hours. And because of that, we can use the futures prices to analyze announcement effects, such as many like these macro data releases, which are usually at 8:30 a.m. That's before the opening of the stock market, right? And then the other two uses are related. The second one is the pricing, right? How futures and options are priced. So that's basically is a mapping of the relevant state variables to the prices. And the third use is the reverse, right? That's the reverse engineering. It's basically given the prices and given some pricing function we derived, and can we infer about the relevant latent variables such as unobserved expectations or uncertainty. So here is my major comment. I think the paper has more emphasis, at least to me, about futures. So for example, in section 7.1, it talks about joint inferences about expectations and risk premiums from futures. And also in the following subsection, it emphasizes on measuring monetary policy surprises using Fed funds futures and the Eurodollar futures. So these are extremely important topics, and the discussion there is really insightful. So I'm just wondering, can some more discussion on option-related work can be added? So Jonathan, in his talk, he already talked about several option-related work. They are more recent. So my talk, I probably want to relate more recent work to kind of the earlier literature to have kind of a more complete view. So I know because the options, literature is enormous. So there's no way we can actually, have a exhaustive list of all the studies. So here I will try to cherry pick a few important influential work. So here I will focus on the two main uses. One is the option pricing, right? I think probably some more discussion about the Black-Scholes-Merton model and the extensions and how they are estimated, very briefly, might benefit readers just to get a better idea. And then the second one related to the third use about how we can extract information from futures or options prices. Jonathan already mentioned something about the risk neutral distribution, and also I talked about the estimating risk aversion coefficients, and I have some other comments on this. And another one is these option prices can be used to provide a model-free implied volatility for, that's how VIX is actually constructed. So I will go relatively quick about option pricing. So this modern option pricing theory really traces back to very early, like 1900s, to the thesis by French mathematician Louis Bachelier, right? He came up with the idea of diffusion. And then, in 1973, we have these Black-Scholes and Burton, big breakthrough about option pricing. And afterwards, different researchers extend this Black-Scholes Merton model in different ways. One extension is to add stochastic volatility, that's in Heston and other related work. But this stochastic volatility model have difficulties with short-term options because volatility tends to mean revert too slowly. So they cannot generate enough kurtosis. The other is another extension, some researchers add jumps. But the problem with this approach is that they have difficulties with longer term options because jumps mean revert too quickly. So over a longer horizon, they don't really matter that much. So there's also binomial tree pricing model. And then, these models are estimated using different techniques like EMM, GMM, and also recent techniques, MCMC, right? And the common finding from this estimation work is that there's a volatility smell effect. So basically, out of money, put or call options, they have higher implied volatilities than out of money options. So they are more expensive, reflecting people want a high demand to get insurance against the tail events. So then for this, the use of options for information extraction. So Jonathan and also the chapter talked about this, about estimating risk neutral distribution. This is one of the important applications. So under the Black-Scholes model, that model implies this log normal risk neutral distribution. This does not hold well in the data, right? And then, so on the other hand, Braden and Lisenberger have this, model-free way to estimate the risk neutral distribution from the option prices. Basically, the idea is that the second order derivative of option prices with respect to the strike price will give us the risk neutral distribution. And then several, there's a strand of literature trying to use the non-parametric estimation to estimate this. So it's interesting is that, so one, now is well known, right? Before 1987 stock market crash, this model, the estimated risk neutral distribution doesn't really have the negative skew or excess kurtosis, right? But after the crash, people take into account these tail events. Now, then the risk neutral distribution starts to have negative skew and excess kurtosis, which is consistent with volatility smells. So as another, once we can estimate the risk neutral distribution, another way to use it is to actually, we can compare it with the objective distribution. The difference is due to the, risk premiums, which is caused by different preferences. So that's why by comparing risk neutral distribution with the objective distribution, people can estimate, risk aversion. So Jonathan mentioned that already. So I want to mention also these works. They use slightly different methods to estimate the relative risk aversion. And also recently, there's a recent work that's actually going beyond rational expectations framework and then allowing for behavior bias, like a probability weighting. So that's another thing I want to point out. So lastly, about this, how another application of the risk neutral distribution is people can use it to construct model-free measure for implied volatility. That's actually how CBOE constructed VIX. So maybe, and then the implied volatility is generally greater than realized volatility. So that's what we know as the negative variance risk premium. And then besides so this variance risk premium is not only related to the risk aversion, and in a recent paper by Drexler, it's also related to ambiguity as well. So, and also there's a large literature about the variance risk premium. So I will just leave it there. So just minor comments, options there's some related uses like for real options, for executive compensation. I don't know whether this is too much, but I believe it's to the authors and also editors. And also there's a futures about Bitcoin. These are recent products. So I don't know whether it was talking about that in the handbook chapter as well. So that's all. Thank you.
Thank you. And I see Stefania's hand up. Why don't you go ahead, Stefania?
So more than a question, I have just a little observation, if it can be useful. Jonathan was mentioning that maybe the premia on interest rate derivative are maybe are there, maybe are not. But after the global financial crisis, for example, there have been at least 2 Fed letters and 1 Fed notes, and I wrote one. But all these central bank publication use different model, and all 3 models find that the risk premium on interest rate derivative has been negative and quite large, even for very short interest rate derivative. And so that has been very important to us to accordingly adjust the policy path to understand what is the actual expectation about the trajectory of the federal funds rate. And so they've been all 3 models have different methodology, but they get very similar conclusion of premia that are between -2 and -4 basis points per month.
So maybe we can hope that you're going to send us references. Excellent. Other comments? There is one in Q&A that goes, especially for the equity index futures contracts, in case there is a mispricing in which the future prices are even below the no arbitrage price boundary that cost of carry model implies, this mispricing becomes long-lasting in many non-negligible examples. What do you think are the reasons for the price correction stepping in too late? That seems like a question for Jonathan. Meanwhile, I see Eric's hand up, so go ahead.
So this is a kind of an easy question, but it just seems like this ought to be 2 chapters rather than 1, right? I mean, there should be 1 chapter on futures and 1 chapter on options. I mean, most of the other chapters have been very, very targeted at muni bonds or repo, and I was kind of surprised to see this chapter on this enormous 2 topics all lumped together.
I blame the editors. Yeah. In hindsight, perhaps we should have done so, but we kind of thought futures and options on the same exchanges, on similar ideas, we can handle this at one go, and hopefully we're not going to embarrass ourselves too badly at the end of this. But it is true that, it's difficult to be evenly futures and options, so we get, Binwei complaining rightly that we are more on futures, and we're going to rectify that some, but it's not going to have the same depth as some other things. Then again, as a consolation, I can offer the kind of trivia that one learns when studying a market in detail, that the Onion Futures Act, my friends, as you might have guessed, prohibits writing futures contracts on onions in the United States. And that's one of the 2 things in the United States that you cannot write a futures contract on. The other one being, still under the Onion Futures Act, is motion picture box office receipts. And that's the detail these authors went to be able to write this chapter. Thank you. I'm mildly making fun of us, but Eric is right. I think we might have and probably should have split this into 2 sections, 2 chapters, and it wasn't that we couldn't find authors. At the get-go, we thought, we'd go ahead and write the futures and options chapter, and we should have asked you when we thought of that. Jonathan.
So I thanks very much, Ben, for your comments. I think as with a lot of these chapters, this is a topic on which we could write a book, not a chapter. And so we're going to have to go away and think hard about what we can squeeze in. But I totally agree that we should increase things a little bit on the option side. On the interest rate derivatives and the term premium that Stefan is talking about, I should be clear that I think all the empirical work I know that is looking at interest rate futures, even as little as 3 months out and beyond, finds significant term premia and time varying term premia. The only place where I think there's even a question of how big they are is in something like Kuttner surprises. So this would be next month Fed funds futures or current month Fed funds futures. And we will look at the references that you send us, and we'll definitely include them. But if we're talking about a term premium of 2 basis points, that may not invalidate the use of Fed funds futures as monetary policy surprises for the target funds rate, if we ever get back to having target funds surprises again.
In particular, if that thing is sufficiently time invariant within the month.
Exactly.
Yeah.
Yeah, it's just that they become a little bit more important with forward guidance because we are extending the horizon of the surprises, and at this longer horizon, the premium become.
At these long horizons, these premia have always been there. Yeah.
Great. So Jonathan had the opening bit. Let me do the closing bit. So we're still 30 people here after 2 days of dense presentations and 20 papers, actually. I mean, this was a packed conference, and it really was wonderful. Thank you all for writing these chapters and discussing them and being here throughout. But what a pleasure. It really, both for those of us who are Federal Reserve Board's emeriti, the reunion, but also the pleasure of talking about these topics that are dear to our hearts with people who share the same sentiment. So I really, really deeply enjoyed this, and I learned a lot, embarrassingly much so. But thank you so very much. You're going to hear from Jonathan and me, both in terms of page budgets and in terms of feedback. And probably tomorrow I'll send an email asking all discussants for their slides so that we will have them to help us offer feedback and also to convey to authors. But once again, thank you all very, very, very much. And let me thank again Sanem and Mahmoud, who are sleepless and have done a wonderful work of making sure that this whole thing worked without a glitch. And with that, my friends, hopefully next time we'll all be in person together talking about these things.